Housing stocks are on the move as the president says he wants to ban large investment firms from buying single-family homes. But that said, some hope out of CNBC's latest housing survey. And for that, we're going to turn to Diana Olick. Morning, Diana.
Good morning, Carl. Yeah, more real estate agents said they thought the market was balanced between buyer and seller in Q4 compared with Q3 of last year. But they're still having to convince their clients on both sides of the trade. This, according to CNBC's exclusive quarterly housing market survey. Now, far more agents, 65% of those we surveyed, said they expect the market to improve compared with 48% in Q3. Far fewer also expect the market to get worse. Lower prices, of course, certainly play into that. 92% of agents in Q4 had at least one seller cut the price versus 89% in the previous quarter. And of those, nearly half said it wasn't just a few sellers, but the majority of their sellers cut prices. More agents said it was a balanced market rather than the buyer's market they were seeing in Q3. And yet their buyers and sellers still have very different expectations.
Buyers tend to think that the market is like 2008. And sellers tend to think that the market is closer to 2021, 2022. And those are diametrically opposed markets and diametrically opposed mindsets.
2008 was, of course, during the housing crash when buyers had all the power, and 2021 was the start of the pandemic when just the opposite was true. Still, buyers appear to be getting used to the new normal and feeling somewhat better about prices. Agents said fewer buyers left the market in Q4 than Q3 and fewer delayed purchases. They also compromised on features they wanted less. It all begs the question, what will the upcoming spring market look like? And agents in our survey used words like stabilization, cautious optimism, and pent-up demand. All positive, but it will depend on the economy and interest rates, as of course it always does. There is much more from this survey on CNBC.com. Go there right now. It's all up. Back to you guys.
All right, we will, Diana, but also wanted to get your thoughts on how the president's potential executive order here that he teased on housing will impact prices and affordability of homes, which, as you've been covering, is a huge issue. He wants to get Wall Street firms out of the home buying business. How much of a dent could that make?
Well, so we're looking at the numbers, really, and what we do know is that institutional investors who own more than 1,000 properties really only make up 3% of the entire single-family rental market, less than 500,000 homes of the 14 million homes. Yes, they are concentrated in certain locations like Atlanta, Jacksonville, Florida, and Las Vegas and Phoenix. Now, some are questioning whether this is kind of a swing state play because those homes are concentrated in swing state areas. But again, overall, for the housing market, even if you take single-family investors out, we still need more homes. And remember, a lot of these single-family rental investors, names like Invitation Homes and American Homes for Rent, they're also home builders. They build entire rental communities, and we do need that housing stock. So you could really look at it either side of the table, but there has been actually bipartisan support for bringing investors out of the market simply to get more of those lower-priced homes out for home buyers. Will it help? It remains to be seen. We also know that they would probably need Congress to do this, so we don't know how it would actually happen in reality.